Do you think that we are seeing what I heard one bullion dealer refer to? He said this isn't a manufacturing bottleneck where it's like, maybe the US Mint gets surged by demand, they run out of minted product, so they have to catch up, but the silver still exists somewhere, or same with gold. Is it a case of that, or is it another case where they don't have the next pile to grab the metal from, and we've actually reached the point where the market is calling in the paper?
I think it's the latter. I think your latter explanation is the dynamic that's going on.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And a quick note before we get started. Good news, the big silver short, the audio version is finally ready to go. Going to be released on Friday, March 27th, 8 p.m. Eastern. We're even throwing a party on YouTube. We'll be taking questions about the book, about how what the book describes is actually playing out in the markets now, where we've seen another paper smash, and in response, seeing a surge in demand. Are we leading to the break point? What's going to happen? All of that is exactly what the book is about. It was done in interview format, 15 interviews with the world's top silver experts. Ted Butler's in there. Andrew Maguire's in there. Craig Hemke, David Morgan, Andy Scheckman of Miles Franklin, all getting to the heart of this issue. Why did the price of silver get destroyed so thoroughly since 2011 when the money printing has raged on? So I think you're going to love it. Audio version finally ready to go. Print version a couple weeks behind, but Friday, March 27th, 8 p.m. Eastern, it is going to be available. So with that said, here is today's video. Chris Marcus here with you for Arcadia Economics. And as the world continues to have some shocking changes, grateful to have Dave Kranzler of Investment Research Dynamics joining me again on the show to dig into some of the fascinating things happening in the gold market, the LBMA. We also got unlimited quantitative easing out of the Fed this week. Almost seems like years ago, where it's just slipped in and print away. But with that said, Dave Kranzler, how are you today, sir?
I'm just grateful to be alive another day so I could do another show with you, Chris.
Well, I sure appreciate that. I'm glad to have you on here. And
Here's my nugget of wisdom for the day before we get started, because otherwise I'll forget.
Okay.
So you spell gold, G-O-L-D. I mean, I know a lot of people don't know how to spell gold, but guess what you get if you remove the L?
God.
I'm not a God guy, but I always was kind of amazed by that, and have wondered if in the history of words, if that was intentional when the word gold was invented.
Yeah, well, I mean, I guess it's better than removing the O and getting GLD, right? So
you get, you know what? You remove the O and you got nothing but a piece of paper, probably backed by not much.
yeah, which, speaking of which, seems to be possibly what's happening on the LBMA. For folks who may not have caught it, I thought it was interesting. They issued an announcement this week about liquidity issues. There was an announcement from the CME. And my quick take was it reminded me of some of those announcements a government official makes warning people that everything's okay right before the currency is about to plummet. But Dave Kranzler, what did you think of those announcements of liquidity issues in the face of a surge in demand, not shockingly in response to the Fed saying they're going to do unlimited quantitative easing?
Are you talking about the liquidity announcements on the LBMA and the
Yep.
COMEX?
Mm-hmm.
Well, I mean, it's just like the economic and financial problems that were starting to bubble up way before anyone ever even heard of coronavirus or COVID-19, way before the first known case was disclosed in China, which I guess was mid-December or something like that. I mean, the Fed knew there were problems as early as mid-September and probably before that, because that's when they started printing money, even though they didn't call it that. They called it overnight repo operations, which then became 2-week repo operations, and then so forth and so forth. So there was a growing shortage of available bullion bars in London, available to be delivered unencumbered by hypothecation agreements, lease agreements, etc. Well before that news announcement was made, well before the COVID-19 crisis started. Okay, so
In fact,
it's
you were
not.
even on the show talking about it in January.
That's correct, and it was going on before that. And I mean, I wasn't the only one who was clued in on the information flow about it. I mean, Alistair McLeod and Egon von Greyers, he's in Switzerland, Alistair's in London. I mean, they're way closer to the situation than I certainly am. They were alluding to it in interviews on King World News. So, at any rate, I think obviously the closure of the refineries, the gold refineries in Switzerland, has exacerbated the problem. But those refineries didn't close down until the last week or two, and offsetting the lack of new refined bar supply, India's gold market's been shut down now for a few weeks. So you've taken away what is typically the largest or second largest demand for bullion bars. So that source of demand is gone. So why all of a sudden do we have a problem? I think this entire crisis has given the LBMA and the COMEX a cover story to actually announce that there's a shortage of physical gold, and I mean that's the only way that I can make sense of it. It's a problem that was there before the virus crisis, and it got worse. It was made worse by the virus crisis, but it was going to come to a head at some point anyway. Now, curiously, China has not closed down the Shanghai Gold Exchange.
Yeah.
And the world only sees how much gold goes into China through Hong Kong. Gold goes into China through Beijing and Shanghai also, and China purposely does not report those numbers. So the only people in the world who can tell you what those numbers are the Chinese government and the People's Bank of China, and that's it. So anyone who says that they know, based on Hong Kong numbers, Hong Kong export into China numbers, how much gold China's been consuming or hoovering, and also based on the amount of withdrawals from the Shanghai Gold Exchange, they don't know what they're talking about, because the People's Bank of China doesn't have to get its gold through the Shanghai Gold Exchange. Everyone else in China who buys gold, everyone has to get it. That gold is at least moved through the Shanghai Gold Exchange, but the People's Bank of China does not have to source its gold from there. So we don't know what the real numbers are in China, and I suspect that the amount of gold going into China contributed greatly to the shortage that was developing way before the virus crisis.
Right. So I think you kind of just answered this, but I'll ask it again in a different way. Do you think that we are seeing what I heard one bullion dealer refer to? He said this isn't a manufacturing bottleneck where it's like, maybe the U.S. Mint gets surged by demand, they run out of minted product, so they have to catch up, but the silver still exists somewhere, or same with gold. Is it a case of that, or is it another case where they don't have the next pile to grab the metal from, and we've actually reached the point where the market is calling in the paper?
I think it's the latter. I think your latter explanation is the dynamic that's going on. I don't look at the mint. The mint doesn't. Sales from the mint and the demand for the product that the U.S. Mint sells, or the Royal Canadian Mint, etc., that doesn't really drive the market. That's a very small percentage of the gold market and the silver market. It's the institutional market that drives the gold, and the sovereign, extremely wealthy and institutional market drives the gold bullion market, and that's what drives the gold price. It's not, these guys who throw this analysis out there saying, oh, there's a shortage of silver eagles. That means there's a shortage of, that. I mean, yeah, I mean, it's indicative. It can be indicative of what's going on in the overall physical market, but the mint doesn't drive the market. So, so I think my guess is, when you can probably find 100-ounce silver bars or 1,000-ounce silver bars at a much lower price or a much lower premium than where silver eagles are trading right now.
Yeah. Yeah.
So yes, I do believe that. The world kind of poo-pooed the quote unquote gold bugs, for saying there was eventually going to be a point where the world would reach a point where the amount of paper claims looking for physical gold was going to far outweigh the amount of physical gold available. And we were moving toward that anyway before the virus crisis. And the virus crisis and the shutdown of the refineries has exacerbated it and made it happen more quickly. But we were headed there anyway.
Yeah, it seemed like it was always just a matter of time, and perhaps now we have reached that time. Any thoughts on the coordinated announcement between the LBMA and the CME/COMEX, where the LBMA is saying they're having liquidity issues, that they're going to ensure an efficient market in New York? It just, again, seems strange to see both of them make these kinds of announcements, which usually doesn't happen unless there is something going on. So any thoughts on the particular coordination between the two?
I think it's a bunch of BS. I mean, the announcement is that the COMEX is going to rewrite its contract. I think it's maybe starting with the April contract, that's such that it would enable them to deliver 400-ounce LBMA bars. Well, it doesn't make sense that there's a shortage of bars in London and a shortage of bars in New York, and of 100-ounce bars in New York, and they're going to fix the problem by allowing COMEX contracts to settle with 400-ounce bars. It doesn't make any. Does that make sense to you?
Well, it makes sense from a bullion banking perspective. From that, it makes perfect sense.
Well, here's the theory underlying that, or here's what they hope the solution is. They'll if you're long a COMEX contract and you want your 100-ounce bar delivered, and they or let's just say, you've got 4 contracts, you want 400 ounces delivered, and the COMEX says, okay, look, the best we can do is get you a 400-ounce bullion bar in London, but since flights are restricted, you're going to have to leave the bar in London for the time being. Well, how are you going to know if that bar is really there? I mean, they're going to give you a piece of paper that you're entitled, and I don't know if they'll even give you one that's with a specific serial number. And even if it is a specific serial number, how are you going to know that there's not other people out there holding the same piece of paper with that serial number on it? You know what I mean?
Mm-hmm.
So, I mean, it harkens back to when CNBC made a big deal out of Bob Pisani going into the HSBC vault, that where there was allocated GLD bars, and he was directed to go over to a pallet in the GLD allocation area, and they said, there's our gold there, and he held up a bar, and the camera zoomed in on the serial number, and it turned out the serial number wasn't a GLD bar. So, I mean, right then the whole world should have known, what's going on with GLD. So, I would say that the COMEX offering to settle your contract in LBMA bars it's just piling on another paper claim on gold that's not there.
Sure does sound like it, and perhaps that's the kind of stuff that led to a spot price divergence between the spot price and the April contract this week. Was wondering if you could explain what that actually means for folks.
I mean, explain why it is happening that way, or explain what it means. I have yet to see an explanation that is satisfactory. But, that said, why would people, futures contracts, future prices should trade higher than spot gold, right? You went to Wharton. I'm sure you took a class on how to value futures contracts.
Not allowed to say gold there. They throw you out for that. So
right, but they, it's you can, the same math applies to cattle futures, right?
Yeah.
You got a current month contract. You take delivery of the cattle future, and it's basically the same as a spot. That's your spot price, is the current month price. The futures price in a normally functioning market where you expect the price to go higher, futures prices should be higher than spot prices because you got time value of money and you've got storage cost and then some measure of expected volatility in the future price, right? It's pretty simple. You don't have to get into the fancy math to explain it. Now, in terms of, I don't really look at the Kitco price and see that as the spot price. It's a derivative of the spot price. The official spot price is the AM and the PM gold fix in London, right? And then Kitco's, I used to know what the formula was. They have some formula that derives their price that they call the spot price, and it has to do with like the term structure of futures prices, and it's like a weighted average of that plus the most recent London price fix. So, I mean, and I guess it works if you're trying to do business, selling coins or selling bars keyed off of the spot price. I guess it's the best thing you have when you got markets that function basically 24 hours. So, I mean, I guess the spread between the futures right now and the spot price is a lot wider than it might be normally. Well, to me, it's simple. Explanation is pretty simple. People know that if they try to buy gold for current month delivery, they're probably not going to get it. So they're going to go out and they're going to bid up the futures contract because they expect that you're worried the price is going to start running up even higher, which is where we are right now with all the currency devaluation and money printing going on. So I don't think it's that unusual for this type of spread between futures price and spot price. It just means the market it has the expectation that I'm willing to pay a lot more for a futures price because I'm hoping that the way once the refineries start up, it means that I'm going to get a delivery guaranteed theoretically, and so no one's talking about silver. I mean if you look at the numbers, the current spread between the latest LBMA price, which was 1605 yesterday, and then let's just say around that time, gold was trading, I don't know, around, I just say 1660 or whatever. So your spread is close to 3%. The spread between the spot and the future price, right? Well, the spread between the spot price for silver and the future price for silver, the current month futures price, is 30%. No one's talking about that. Why is no one talking about that? Because extremely wealthy sovereigns, central banks, and big institutions don't buy silver. They buy gold because they can put a lot more money to work, more easily by buying gold as a wealth preservation tool than buying silver.
Yeah, it makes sense, and certainly fascinating to see what's happening with some of these spreads and how it will unravel going forward. So, Dave, I know there's a busy market going on today, so I appreciate you making some time to join me. And folks, if you're looking for more insight into the gold and silver market, Dave does have the Mining Stock Journal and also the Short Sellers Journal, which you can find at Investment Research Dynamics. So again, you can find Dave at Investment Research Dynamics. And folks, if you want some more coverage of what's happening in the gold market, just stay tuned, and here you go.